You might have thought about or heard of many different types of investments. This world is full of chances to invest, like in busy stock markets or starting your own small business. But today, we're focusing on a very interesting choice: real estate. Why is it special? How is it different from other ways to build wealth, like stocks and small businesses? We will look at how real estate is similar to and different from these other ways to invest. The first attribute that we will look into is returns. A lot of people choose to invest in real estate because it can bring good returns. These returns come from two main things: the regular money you earn from the property, like rent, and the increase in the property's value over time. Real estate is similar to stocks and small businesses because it's an ownership investment. This means it's something you own that can make money regularly and can also increase in value, giving you a profit when you refinance it or sell it. According to research and what we've learned, the money you can make from real estate investments is often similar to what you get from stocks. On average, it's around 8 to 9% each year. In the past years, the money earned each year from real estate investment trusts has also been about this rate. Real estate investment trusts are companies you can invest in and make money from properties like apartments, offices, and shopping areas. You can get yearly returns that are often more than 10% if you pick really good properties in the best places. You need to keep them for many years and take good care of them. Think about this example. Imagine you have $200,000 to invest, like Sarah and John. Sarah buys a rental house and rents it for $2,000 a month. After paying for repairs and other costs, she earns about $15,000 profit for the year. Over time, her rent might go up and the house itself might become more valuable. John invests in a company instead. It does well, so he gets a $10,000 payment and his shares become worth more. Both Sarah and John made money on their investments. Sarah's profit came from rent and the potential for her house to be worth more in the future. John's profit came from company payments and the increased value of his shares. It's hard to say who will do better in the long run. It depends on how the house and the company perform. Let's talk about risk. Risk in real estate means there's a chance you might lose money or not meet your money goals with your real estate investments. Real estate values don't always go up. Remember, in the late 2000s and early 2010s, most places in the US saw real estate values drop. But real estate prices usually don't change as quickly as stock prices. Think about the late 1990s, when tech and internet stocks were really popular and their prices went up fast. Then, in the early 2000s, those same stock prices fell a lot. Many of these stocks, even the big ones, lost 80% to 90% of their value. With houses and buildings that you rent out, you usually don't see such big changes in value in a short time. Remember, if you worry about short-term risks, real estate prices can drop by 10%, 20%, or even more. Imagine you put down a 20% down payment and then need to sell your property after its value has fallen by 10% to 15%. In such a case, you might lose all your invested money, that is, your entire down payment, especially when you include the costs of the transaction. So, there's a chance you could lose everything. Here's some known fact. When you invest in real estate, holding on to your property for a long time, like 7 to 10 years or even more, can really help lower your risk. Keep in mind, a lot of those stories about making big money quickly by flipping houses or small rental properties don't always show the full picture. They're a bit like people who gamble and only talk about their biggest wins, but don't mention their losses. Despite what you might see on TV or online about making quick profits from flipping properties, it's smarter to think about real estate as something you invest in for the long run. Moving on, we'll tackle liquidity. Liquidity means how quickly and cheaply you can sell an investment and get your money back. Real estate has a bit of a problem with liquidity. It's not very liquid. Selling a property takes more time than just using your ATM card to take money out of your bank account. It's also slower than selling stocks or funds with a click on your computer or a tap on your phone. Real estate isn't as easy to buy or sell as stocks, and that can be a good thing. With stocks, it's tempting to focus on short-term price changes and make decisions based on emotion. Since you can't constantly check the value of your real estate and selling takes time and effort, you're more likely to hold on to your properties for the long term. This can lead to greater gains. While less liquid than stocks, real estate is still easier to sell than a small business. People always need homes and businesses need places to operate, so there's a consistent demand for property, even if finding the right buyer takes time. For example, you need $20,000 right away for a sudden car repair. Option 1. Stocks. If you have $20,000 worth of stocks, you can likely sell them online and have the cash in your account within a few days. Option 2. Your house. Selling your house to get $20,000 is impossible in such a short time frame. It involves finding a real estate agent, listing the property, negotiating with buyers, and going through the closing process. This could take months. This example shows the difference in liquidity. With stocks, you can usually sell them and get cash in a few days. But if that money is tied up in a property, it will take much longer to get it. Selling a house takes weeks or even months, so you should consider this before entering the world of real estate investing. Now, let's talk about diversification value. Real estate offers a safety net because its value doesn't always change in the same way as other investments. Think about a time when the stock market crashed. Remember how many people lost money? During that same time, most home prices stayed the same or even went up. This means if you own stocks and real estate, you spread out your risk. If one investment type goes down, the other might help keep your money safe. Be careful. Sometimes both real estate and stocks can lose value at the same time. For example, if the whole economy is doing badly, businesses might make less money. This can hurt the value of both stocks and your properties. Let's pretend you have $100,000 to invest. Now let's look at your options. Option 1. If you put all your money in stocks and the market crashes, you could lose a lot. Option 2, but if you put half in stocks and buy a rental property with the rest, you're spreading out your risk. Even if the stock market drops, your property's value might stay the same or even go up. This is how having different kinds of investments helps protect you. If one investment does poorly, the others might help balance things out. Finally, let's talk about not paying taxes when you make money from selling rental properties. Imagine you sell something like a stock or a mutual fund that's not in a retirement account. You usually have to pay taxes on the money you made. But if you sell a rental property and then use that money to buy a similar kind of property, you don't have to pay taxes on the money you made from the sale. You need to follow certain strict rules to correctly do a 1031 exchange, which is a complicated process that includes other people. A 1031 exchange is a special kind of deal in the United States that lets you delay paying taxes when you sell a property and then buy a different one. The name comes from Section 1031 of the U.S. Tax Code. The main idea is that if you sell a property and use the money to buy another property, you don't have to pay taxes on the money you made from the sale right away. But to do this, you have to follow certain rules very carefully. It's important to get help from a lawyer or tax advisor who knows a lot about these kinds of deals. They can make sure you do everything right and on time, so your exchange happens without any problems and follows the law. Selling a property after the price goes up sounds great, but there's a catch: taxes. The government wants a share of your profit. It gets more complicated because they also tax you on something called depreciation. This is an amount you've been able to deduct from your taxes each year while you owned the property. Let's say you bought a property for $200,000, and over time you deducted $125,000 for depreciation on your taxes. The depreciation deductions reduce your tax basis in the property, meaning the property's value for tax purposes is lowered by the amount of depreciation claimed. Therefore, when you deduct the total depreciation, $125,000, from the original purchase price, $200,000, your adjusted basis in the property becomes $75,000. If you sell it for $550,000, you'll owe taxes on the difference between the sale price and this adjusted basis. In other words, your taxable gain is calculated as $550,000 sale price minus $75,000 adjusted basis, which is $475,000, not just the sale price minus the original purchase price. This $475,000 is subject to capital gain tax. This is a much bigger number to pay taxes on, highlighting how depreciation impacts the taxable gain when selling a property. In accounting, this phenomenon is called tax recapture or depreciation recapture. Depreciation recapture is the gain realized by the sale of depreciable capital property that must be reported as ordinary income for tax purposes. Depreciation recapture is assessed when the sale price of an asset exceeds the tax basis or adjusted cost basis. All right, let's wrap it up. Real estate investing can be profitable, but it also has risks and things to think about, like taxes. It's similar to stocks and owning a business because it can earn you money regularly and grow in value over time. However, property values usually change more slowly than stocks, making it a steadier long-term choice. It's important to understand the risks before you invest. Property values can go down, repairs can be expensive, and selling a property takes time. It's best to invest in real estate for the long term and make sure it fits your own money goals and how much risk you can handle. Real estate can be a good choice because its value sometimes moves differently from other investments, like stocks. It also has tax benefits, like letting you delay paying taxes when you sell one property and buy another. But tax rules are tricky, so it's smart to get help from a professional. Thanks for watching. Our channel is dedicated to making investing, finance, and economic concepts easy to understand, empowering you to make smarter financial decisions. If you found this video helpful, others might too, so please share it to help them benefit as well. Help us spread the word by subscribing to our channel. Let's make finance and investing knowledge accessible to everyone. And don't forget to check out our website at www.investingcouncil.com for more information and resources. See you next time.